I'm Ric Edelman, and this is The Truth About Money. On today's show,
buying gold is absurd. It is absolutely absurd.
I have a couple friends who I know will never pay me back, so I'll be sure to keep my money away from them.
Well, there aren't too many players earning $100 million.
And that's why there aren't too many players who develop lifetime security.
A lot of parents are struggling with the issue of, what language would make most sense for me to make sure my child learns, and a lot of people are saying, well, it's either Chinese or it's Spanish. Your kid's learning both. That's really annoying.
That's all coming up right here, right now on The Truth About Money. Are you willing to lend money to a friend or family member? We asked people out on the street, and here's what they told us.
Absolutely not.
I have a couple friends who I know will never pay me back, so I'll be sure to keep my money away from them.
I just think that people that come to you looking for money usually have poor spending habits, and typically they're not going to be able to save it to repay it. And if they're really down and out and you really need to help them, I'm willing to do it, but typically it's just poor spending habits.
But it has affected some of the relationships over the years, absolutely.
I work too hard for my money.
I would give money to a family member or a friend, but I would not lend money.
If they're in dire need of it, yeah.
I would lend money to both, because in times like this, when people need stuff, you never know who you can count on.
Oh yeah, to friends, and they don't pay me back, so I don't even worry about it.
We helped a fellow open up a business, and it didn't work out very well.
I have, and it's a really tough situation, and I'll probably never do it again.
Lots of people lend money to friends and family. You should do it, though, only if you're willing to lose the money or the friend or relative, and you might lose them both. Lending money to friends and family is one of the easiest ways to damage your relationship. If the person doesn't repay the loan, you might become resentful.
Yeah, so what? Lent you $1,000.
Other friends or family members might get involved, and before you know it, social gatherings are rife with tension.
I'll pay you when I can. No.
If you insist on lending money to a friend or family member, make sure you do it the right way. That means drafting an official loan agreement, just like you would with a stranger. If the borrower balks at signing, don't lend the money. Any borrower who truly plans to pay you back should be willing to say so in writing. The loan agreement should state how much money is being loaned, the repayment schedule, and the interest rate that you'll charge. That's right, you must charge interest. It can be a low rate. The IRS decides how low, but it can't be zero. The agreement should also stipulate penalties for things like missing payments or bouncing checks. If you don't do all this, the IRS might not consider it a real loan agreement. And if you don't do all this and the borrower doesn't pay you back, you, not the borrower, could owe the IRS gift taxes. If the borrower doesn't pay you back and it becomes a bad debt, you can deduct it on your tax return. But the IRS will want to know that you've tried everything to get the money back, which might include filing a lawsuit against the borrower. So if you're not prepared to sue your relative or friend, you probably can't take the tax deduction. Yeah, lending money to family members can be treacherous. If you're willing to do it, make sure you follow my advice. Draw up an agreement and ask the borrower to sign it. If he won't, let him go elsewhere for the loan. I know you want to help a friend or relative in need, but don't put yourself in crisis merely because they're in crisis. Having two people in crisis instead of one doesn't do anyone any good. Audience Q&A is a ton of fun, and sometimes I even give good information. Check this out.
Hi, Rick. My name's Linda, and I'm wondering, I'm in a position where my personal situation has just recently changed. I was fortunate that I was able to refinance my house, and I'm wondering, though, my cash is very tight. I can make the mortgage. I'm fine in that regard, but it's just very tight. I'm wondering if I should take an opportunity to rent my house, to rent my house out, and then look for a place to rent that would probably allow me to save about $1,000 a month, $800 to $1,000 a month. Is that a smart decision if I limit the time frame?
yes, if all of your assumptions work. If you're able to find a tenant willing to pay the rent enough to enable you to lower your mortgage costs net of the rent you're going to pay in the next property, and if the tenant does in fact pay rent on time, and if the tenant doesn't trash the property, because let's face it, tenants don't treat properties as well as owners do. So if all of those things prove true, and you don't object to the lifestyle change associated with that yourself, sure, it's a great idea. But keep in mind that the costs of homeownership won't go away. Repairs are still going to be incurred, and you're going to have to deal with those, which means you're either going to hire someone to make the repair, or you're going to have to become a handyman and make those repairs yourself. So as long as you're okay with those issues, what I like to refer to as the hassle factor. In other words, nobody ever calls me at 3 o'clock in the morning because something went wrong with their mutual fund. But as a landlord, you might get a call at 3 a.m. because of something went wrong with the house. So as long as you're prepared financially and psychologically for the issues of becoming a landlord, and if your assumptions are correct on the economics, then yes, it can work out just fine. I would recommend you meet with an objective financial advisor who can go through your assumptions with you to validate that the plan is going to succeed.
Okay. I think I'm in a place where I would profit about $300 to $500 a month by renting my house. So that I would have that extra income to pay for the repairs or whatever the maintenance might
And if that
happen.
proves true, then it sounds like a plan that is worth pursuing.
Okay, thanks.
Have you thought of the idea of staying in the house and adding a boarder so that you don't incur the extra rent expense yourself?
That has been a thought that crossed my mind, but I like the privacy, and I have a child. And to have a tenant in my house, it's not really set up in a way that would give us each privacy.
Gotcha.
So I did think about that, and I'd rather rent my house out and have my own home
As long as
separately.
you've given it the thought, then that's okay.
Okay, thanks.
Hi, I have a question about college. My child is 6 years old now, and God willing, in the year 2029, he'll be starting college. He speaks 3 languages, and we come from a multicultural family. I'm looking at college funds. My concern, though, is that it limits his ability to go to college to only certain U.S. schools and very, very few international schools. And he might want to go to, I guess in 2029, China will be doing quite well, and he speaks Mandarin. And also, Mexico and a lot of the Spanish-speaking countries will be doing quite well. And they're projecting that the educational systems will be among the finest in the world. So I would like him to have the opportunity to go wherever he wants to go in the future. How should I save for him?
A 529 college savings plan. Without a doubt, that's the way to go. And I'm already incredibly annoyed and jealous of your son. A lot of parents are struggling with the issue of, what language would make most sense for me to make sure my child learns, and a lot of people are saying, well, it's either Chinese or it's Spanish, and your kid's learning both. That's like really annoying. So here's the good news. In a 529 college savings plan, here's how it works. You can put the money into the account. You can open an account for as little as $25. You can put in as much as $250,000. So you can really put in as much as you want without having any concerns about qualification. Once the money goes in there, it grows tax deferred. And if you use the money for college, you can pull it out completely tax-free. So this is the greatest savings vehicle ever for college planning purposes. These plans are created and run by each of the states, and the states have hired mutual fund companies to run the money for them. So you can either invest in your local state plan or some other state if you wish, go find the mutual fund company you like best and buy the plan from the state that offers that program. Very simple, very easy. And here's the best part. The money can be used for all college expenses, not just tuition, but also room and board, books, computers, everything except travel. And it's valid at any accredited institution anywhere in the globe. So it is not limited to United States institutions. It is only limited to accredited schools. So your son will have the flexibility of using this wherever he chooses to go.
I've actually looked at some of the colleges that I think in the future he might be interested in, like some of the finest colleges, in Beijing, Renmin Dashue and Beijing University, and I've looked at some of the colleges in some of the Spanish-speaking countries, and they're not accredited. So what should I do?
Go find one that is. Doc, it hurts if I go like that. Well, don't go like that. But there's another element as well. Many of the finest institutions around the world don't cost nearly as much as the institutions in the United States do, which means you might well discover that the cost of going to one of those institutions is a lot less, and therefore the ability for you to save enough to send your son there is easier than it would be to send them to an Ivy League school in the United States. So you just need to evaluate what is the likelihood that you're going to send your son to college overseas. Let's take a look at what those college costs are, both now and projected into the future, based on historical rates of inflation for those institutions. And now let's do some math to figure out how much money do I need to save on a monthly basis right now between now and 2029 so that the bill is paid for by the time he enters college.
What would I do if I do save in a college fund and he decides not to go to any college or any accredited college?
What if your son doesn't need the money? What if he gets scholarships as well? Isn't it interesting? You thought he'd be a bum and I thought he'd get a scholarship. Either way, let's assume he doesn't need the money. You have two choices. You can leave the money there and spend it on other children in the family, not just your own other children, but his cousins. You can use the money for them. Or you can leave the money there for his children. It can become an intergenerational savings program, let it grow for another 25 years until his kids go to college. Or, here's my favorite, you take the money back. A lot of institutions, Georgetown University does this for example, have non-matriculated study programs where you can go for a 2-week archaeological dig at the pyramids of Egypt. And that counts as an accepted use of the 529 plan assets. So you take it back and go on experiential learning, and you get a tax-free loophole thanks to Uncle Sam.
Thank you.
You think you know everything about selling a house? Prove it by getting the right answer on our daily quiz.
The value of your house is the price you paid for it, the price you paid minus your mortgage balance, the same as the tax assessment, the price the buyer is willing to pay. Stay tuned for the answer.
There are few things I enjoy more than helping people with real questions. Here's an example from my live weekly radio show.
My husband and I have like $20,000 in savings, and we have about $1,000 a month extra that we were thinking about putting towards our mortgage, but right now in the economy and the dollar, losing value, I don't know if that's a good idea to pay off the mortgage sooner, to invest this money into gold or something else. We're not sure what to do now.
So let me get this straight. You've got $20,000 in savings.
Right.
No other savings anywhere else?
Yeah, we both have retirements saved as well.
Okay, how much?
I think there's over $100,000 in there for both of us, and we're in our early 40s.
Okay, and children?
Yeah, 3 kids.
And their ages are?
21, 19, and 13.
Okay.
The 21-year-old doesn't go to college. The 19-year-old has his own debt from college, which we had to co-sign some of the loans for. And obviously the 13-year-old is still in school.
And you own your home. And the value of that house is?
Yeah, we do own the home. It's a rental also. It's a 2-family, and the value of it right now is about $320,000, and we owe about $160,000.
Okay. And you've got an extra $1,000 a month in discretionary income that you can do whatever you want to do with. You can use it to pay off some of those student loan debts. You can use it to throw into savings. You can use it to pay off the mortgage. And the basic question is, which is the best choice, Anderson?
Yeah.
Well, certainly, I wouldn't be paying off that mortgage.
That's the worst of the choices.
Yeah, it's really not a good option. With the equity that you've got in the house, Minette, there's really no reason to be trying to load up into equity. You've also got a situation where it sounds like this $20,000 is your cash reserves. So by taking that $20,000 and giving it to the bank to never be able to get it back without selling the house, you're in a situation where now you've lost your cash reserves. And you've got a potential problem if there's an emergency.
Let me ask you this question, Minette. Do you think over the next 10 years you're going to stay in that house?
That I'm not sure of. I don't really know. We weren't going to use the $20,000 to pay off the mortgage. We were going to use $1,000 a month extra to pay off the mortgage. But the $20,000 is the other thing that we were asking about as far as like what do we do with that? Should we invest in gold? Should we leave it?
How much money, Minette? How much money do you and your husband spend on a monthly basis?
Probably about $4,000 a month with all the utilities for upstairs and on the place. And
you need to have at least $50,000 in cash reserves just as a rainy day fund. You've only got $20,000, so that suggests that this $1,000 a month should be added to that rainy day fund until the 20 grand becomes 50 grand. What you need to do is build your cash reserves, because by building cash reserves, you're going to insulate yourself against the possibilities of the things you're fearful about. Buying gold is absurd. It is absolutely absurd. First of all, it's at an all-time high. You never buy an asset at an all-time high. Second, the only reason you're thinking of buying it is because of the Armageddon that you're hearing pitchmen who are bragging on radio and television in their paid commercials and paid sponsorships of telling you that gold is the great place to be. What they're not telling you is how much of their own money they've invested in gold, the price they paid for the metal when they bought it, and how much money they're being paid to tell you to go buy it. So there's an incredible amount of misinformation out there right now about gold, and it's all fear-mongering. The decline in the dollar that you mentioned, what decline in the dollar? What does this have to do with anything if you're an American living in the United States? The decline of the dollar, which has to do with currency fluctuation, only matters if you export goods and services to other countries, which, by the way, isn't you. And if anything, there's a decline in the dollar due to inflation. And that is a very real risk, but that's not one that you even seem to have mentioned. So my concern here, Minette, is that you're worrying about things you shouldn't be worrying about, and you're looking at safety-oriented strategies as opposed to growth-oriented strategies, and the combination is going to get you into a lot of trouble over time. So let's take this in the fundamental basics. Number one, make sure you and your husband are contributing to your retirement plan at work to the maximum that your boss allows on a pre-tax basis. Number two, take that extra $1,000 a month, add it to your savings so that the 20 grand grows to 50 grand. And then number three, after you've done both of those things, call me back and I'll tell you what to do after that.
The value of your house is the price the buyer is willing to pay.
David Falk was the sports agent behind superstars like Michael Jordan, Patrick Ewing, and Alonzo Mourning, earning record-breaking multi-million-dollar contracts for his clients and becoming one of the most powerful people in sports. At his peak in the 1990s, he negotiated $335 million in contracts in less than a week, including a record $30 million deal for Michael Jordan. Today, he's backed off from the frenetic pace of his early years, but he still represents a number of young players. We spoke with David at his office in downtown Washington, D.C. Most players pick up their agents at very early stages of their career. They're still in high school in many cases, certainly in the college era. That's when you first meet a lot of the folks who ultimately become your clients.
That's not when I meet them.
When do you meet them?
I meet them when they finish playing in college. I'm a dinosaur in this business. I do it the old-fashioned way. When I was in the prime of my career, the coaches at the major universities, Coach Thompson at Georgetown, Coach Gay at Duke, Bobby Knight at Indiana, Rick Pitino at Kentucky and Louisville, Dean Smith at North Carolina would say, look, I don't want you to talk to the players. I don't want you to accidentally bump into them. I don't want you to contact their families. If you do it one time, you're out. You will meet them for an hour in my office when the year's over, but you got to leave them alone. Today, if you took that approach, you probably wouldn't meet anybody. I believe in our business, if the players really understood how business works, not how basketball works or football, they would do their homework and find out, who represents Peyton Manning. If I'm a quarterback, that's the guy I want to represent me. He's done a great job. He's got tons of endorsements. He's making the most money. Who represent Michael Jordan? Who represented, the top players? But it just doesn't work that way because the players aren't sophisticated in business. When I sold my business, I didn't represent myself. I hired Goldman Sachs. I thought they were the #1 company in the world, in that area. And I was very fortunate that Hank Paulson took a personal interest in the sale of our company and called me every week and held my hand through the process. And I think when I walked into the room and the person buying my company knew that Hank Paulson was my agent, I think I made a hell of a lot more money than I would have made if I did it myself.
So you're raising a couple of issues. First, is trust a consideration when you're meeting that young player for the first time to convince that player to work with you? Is trust an issue, or is it merely the deal?
Well, for me, trust is the entire issue.
But what about for the player?
I don't think he understands. I think for the player, it's comfort level. I think most players want to be, quote, comfortable with the person they're picking. They really don't know the criteria to use to differentiate one person from another. They don't understand the importance of a track record. And what I try to educate them is that when you come out of school and you're going to get drafted in the NBA, all your statistics are in, your height, your weight, how many points you scored, what your field goal percentage is. The only variable at that point is how talented is the person you hire to manage your portfolio of assets, if you will, and translate that into dollars on the professional level.
But when you're negotiating or doing a deal on behalf of Michael Jordan or any of your other clients, how much does negotiation skill really matter?
Well, honestly, I think I would call it like dispute resolution. I think it matters when you're having an argument with your wife. You know, I mean, the question is, do you want to win the argument or do you want to resolve the argument?
What's the difference?
I think that some people look at negotiations as a zero-sum game where one side wins and one side loses. When I was in my 20s, that's what I thought. By the time I get into my 40s, I realized that's a really bad attitude, particularly in a long-term relationship like a marriage or in a long-term business like I have in basketball, where I deal with the same owners every year. And I think sometimes there are parameters of fairness, and if you exceed the parameters of fairness, you're going to be in the red zone. You're going to be in trouble. And so I think you don't want to win. You want to make a fair deal. You want to make a deal that's advantageous for your client, but you're going to deal again with the same people over and over.
In other words, you want the other side to win as well.
I think the other side has to win, Rick, in order to make a deal.
Have you seen players with multi-million-dollar contracts actually be broke anyway?
Sure. We started out with a client in 1996 named Antoine Walker. One of my partners, Mike Higgins, managed him for about 10 years, did a great job. He's made over $100 million. He fired us, went with another agent in Chicago, and now he's broke. And you could say, God, what a dummy, but you cry for that kind of a guy, you know, that he took a lifetime's worth of security and didn't make it work for himself. What I try to teach my clients, and I'm not a financial advisor, but because I go through the same process myself, is if you have $1 million lifestyle, you probably need $20 million today you probably need a lot more than that. Getting to the 20 to 25 million is very, very difficult. And I would say that if a guy earned 100 million in today's world of sports and had 25 put away, a financial advisor would think that that's not great performance. And an agent would think, God, thank goodness, you know, he can maintain that lifestyle forever.
So in other words, with all the expenses you mentioned, between taxes and the fees that agents charge and all the other people they need to pay along the way, et cetera, what kind of contract do you think would it take for an athlete to end up with a $20 million piggy bank?
I think you probably have to earn 100.
Well, there aren't too many players earning $100 million.
And that's why there aren't too many players who develop lifetime security.
One of the things we'd like to do in these interviews before we go is to provide our viewers with some takeaways, some tangible action steps or strategies that they can use in their own lives. What one or two pieces of advice would you love to give people?
Well, number one, I would say, definitely be prepared. You know, this is not negotiating contracts at any level. You're negotiating a car, a house, professional athlete's contract. Is about understanding what the relevant market is, what the trends have been in the industry, and the better you're prepared, the better you're going to be at it. And the second thing I'd say at the flip of that is understand it's not a zero-sum game. That your intent is not to win, it's to make a deal. And if you win too much, then oftentimes you're creating a crack that's going to break open the relationship that you're negotiating to build. So learn how to do it while giving the other side their dignity and maintaining a long-term relationship. A lot of it's about goodwill.
David Falk, thank you very much.
Enjoyed it.
Before we go, here's one type of insurance you should never buy: mortgage life insurance. This policy pays off your mortgage if you die. Why on earth would you want to give the money to a mortgage lender instead of your spouse? That's not the only problem with these policies. The premiums are high, and the benefits actually go down every month as you continue to make mortgage payments. There are much better ways to buy life insurance, and a financial advisor can help. And that's the truth about money. I'm Ric Edelman. Thanks for watching.